Hi, I'm Emily Carter. Today we're talking about a company almost everyone uses, but one that Wall Street seems to have quietly pushed aside. Cable, internet, streaming, even theme parks. This is Comcast, and the market might be seriously underestimating it. Comcast isn't a hype stock. It's not exciting, and it's definitely not trending on social media. But here's the thing. Millions of households pay Comcast every single month, not because they love it, but because they actually need it. And in investing, need almost always beats hype. So let's break down how Comcast really makes money. First, there's connectivity, Xfinity. Cable TV might be shrinking, but demand for fast, reliable internet keeps growing. Second, there's NBCUniversal. That includes TV networks, movie studios, sports rights, and advertising. And third, theme parks. Often ignored by investors, but surprisingly profitable, especially with Epic Universe opening in 2025. So this isn't just one business. It's diversification built right into the model. Now, before we talk about valuation, we need to ask something very simple. Is Comcast actually a healthy company? And when you look at the data, the answer is pretty clear. Financial health is rated great, cash flow is good, growth is good, profitability is also rated great. This is not a struggling business. This is a solid cash-generating company. Now here's where things start to get interesting. Based on current valuation screens, Comcast shows up among the most undervalued stocks in the U.S. market. The stock is trading around $30. Estimated fair value is closer to $47. That implies more than 57% upside. That's not a small difference. That's the market clearly mispricing something. And here's the number Wall Street really doesn't like to talk about. Comcast's P/E ratio is below 5. For a company with recurring subscription revenue, stable cash flow, broadband infrastructure, and real-world assets like theme parks, that kind of multiple isn't normal. This isn't just pessimism, it's fear-driven pricing. So what about streaming? What about Peacock? Is it Netflix? No. Is it profitable yet? No. But here's the key point. Comcast doesn't depend on streaming to survive. Peacock is an option, not a lifeline. And that makes a huge difference. Interestingly, most analysts still rate Comcast as neutral, not because the business is weak, but because it's boring. There's no AI story here, no explosive growth narrative. And historically, that's often when long-term investors quietly start paying attention. Of course, there are real risks. Competition in broadband is increasing. Streaming still loses money, and regulation is always in the background. This is not a zero-risk stock, but the key thing is this. Most of these risks are already priced in. Comcast isn't undervalued because it's broken. It's undervalued because it's boring. And boring, cash-generating businesses are often where real money is made, quietly over time. This is a defensive compounder with infrastructure DNA and optional upside from media and theme parks. I'm Emily Carter, and this was US Stock Stories. Right now, our YouTube channel has 99 subscribers. And I want to sincerely thank everyone who supports this channel, whether you're already subscribed or just watching and sharing our videos. Your support truly means a lot. And finally, I want to wish all of you a happy, healthy, and successful 2026. See you in the next story.